Hey everyone, and welcome to this explainer. Have you ever felt like you are working incredibly hard, making really decent money, but somehow you're still trapped in that stressful paycheck-to-paycheck cycle? It's like being on a financial hamster wheel. Well, today, we are breaking down the exact blueprint to escape that trap. We're going to look at how to build automated, disciplined systems that literally do the heavy lifting for you, completely transforming the way you earn, save, and multiply your money. So here is our roadmap for today. We'll kick things off with the psychology of wealth, then move into building systems instead of just relying on raw willpower. After that, we'll get into the actual mechanics of choosing the right funds, explore the absolute magic of compounding, and finally, look at how to navigate sudden market shocks without losing our minds.
All right, let's jump right into part one, the psychology of wealth and changing how we actually think about money.
I want to ask you a question, and it's a bit of a painful reality for a lot of folks. Why do high earners so often stay broke? You see people pulling in these massive salaries, yet they have absolutely zero actual assets to their name. The problem isn't their income at all. It's that every single dollar coming in is immediately assigned to some lifestyle expense, which leaves absolutely nothing to work for them in the background.
It all boils down to this. Spending less alone will not make you rich, but unconscious spending will absolutely, definitely keep you poor. It's those emotional choices, right? The late-night online shopping just to relieve a little stress, or the lifestyle inflation to keep up with your colleagues. These are the silent wealth killers. We really have to identify these unconscious patterns first, because until we do, no financial strategy is actually going to work.
Let me paint a picture for you with a real-world example. Take three friends, Vijay, Shubham, and Akash. They all moved to Mumbai in 2011 with the exact same starting point. Identical engineering degrees, identical entry-level salaries. But look at how their daily habits drove them entirely apart over just 10 years. Vijay used his salary to fund a really flashy lifestyle, completely trapping himself in massive monthly installment loans for cars and rent. Meanwhile, Shubham lived frugally and quietly researched real estate. And Akash? He just started passively investing 20% of his income into the stock market right out of the gate. By 2022, Akash is set to retire in his 30s, and Shubham is a wealthy landlord. Identical starts, radically different finishes.
Which brings us perfectly to our second step, systems over motivation. This is all about redesigning your environment.
You've probably heard of the habit loop. Every habit keeping you broke follows a strict four-step pattern: cue, craving, response, and reward. Let's say you have a miserable, stressful day at work. That's your cue. You naturally crave some kind of emotional relief. Your response is an impulse buy online, and the reward is temporary comfort. To break this cycle, you can't just tell yourself to try harder. You literally have to redesign your environment. Delete the saved credit cards from your phone. Automate your investments so the money is actually gone and working for you before you even have a chance to feel that stress.
But here's the real game changer. True, lasting transformation requires an identity shift. If you walk around saying, "I want to be rich," your brain just sees that as some external, distant goal. But if you shift your identity and say, "I am an investor," well, your daily actions naturally start to align with that. An investor doesn't blow their whole paycheck on a random impulse buy. When you change your identity, those good financial habits become inevitable.
Okay, let's get into the weeds a bit with part three, choosing the right fund, the actual mechanics of wealth.
There is a massive amount of confusion out there about this, but the mechanics are surprisingly simple. It's basically a showdown between passive and active management. Index funds and ETFs are passive. They aren't trying to guess the future. They just automatically track the top companies, like the S&P 500. Because it's essentially on autopilot, the fees are practically zero. Now contrast that with traditional mutual funds. These are actively managed by human professionals who are trying to beat the market. And because you are the one paying their massive salaries, the fees are exponentially higher.
Now you might be thinking, hey, I will happily pay higher fees if an expert is going to beat the market for me. But get this, over a 15-year period, more than 90% of active large-cap managers actually fail to beat the basic S&P 500 benchmark. 90%. You are quite literally paying high fees for worse results the vast majority of the time. And the impact of those fees, combined with emotional trading behaviors, is absolutely devastating over the long haul. To put that into perspective, over a 30-year period, an investor who just quietly tracks the market in a low-cost index fund will be roughly $250,000 richer than your average investor who keeps jumping in and out of active, high-fee funds. A $257,000 loss, just because of bad mechanics. That is huge. Now for the fun stuff. Part 4, the power of compounding, the absolute magic of time.
Let's check back in on our friends from Mumbai. So 11 years into his career, Vijay finally decides he needs to buy a house to maintain his status. He commits to a massive 58,000 rupee monthly loan payment for a 90 lakh apartment. But here is the incredible, dramatic twist. When he sits down to sign the paperwork, he realizes the owner of the apartment building is his old friend Shubham. Because Shubham had quietly invested in that developing area a whole decade prior, letting his small investments compound, he is now the one collecting the passive income that Vijay is going to be sweating over for the next 20 years.
So how did Shubham pull that off? It's driven by the exact same rule their friend Akash used in the stock market, the 732 rule of compounding. Look, the first 7 years of investing are honestly kind of boring. You're just building the base, and progress feels invisible. But you have to stick with it, because over the next 3 years, your wealth literally doubles its growth speed. And in the 2 years after that, it jumps exponentially. It's exactly like a snowball rolling down a huge hill. You just have to be patient enough to let it roll. Oh, and of course, always factor in inflation so your end goal is actually enough to live on.
Finally, we hit part 5, navigating market shocks. This is the ultimate stress test for all those systems we just built.
We're going to look at a live example here using a recent market event. The second news broke about an enforcement directorate raid on a company called Ananth Raj. Their stock instantly crashed by 9%. Now, it is entirely human and natural to feel absolute panic in a moment like this. But as an investor, it is absolutely crucial to impartially recognize that, at this stage, this is just an investigation. It is not a conviction of guilt. Short-term panic selling almost always follows this exact kind of news cycle.
But before you hit the panic button, you have to ground yourself in logical data. The market has built-in guardrails. For this specific stock, the price band limit dictated a maximum drop to 408 and a maximum rise to 612 in that given session. Seeing that hard data reminds us that the sky isn't actually in free fall. There are mechanical boundaries firmly in place to prevent a total collapse.
So what's the playbook here? A disciplined investor handles these shocks completely differently. They entirely avoid emotional panic selling. Instead, they fall back on those automated systems we set up earlier. If you're playing the long game, you simply wait to see what official financial data actually emerges from the situation, rather than just reacting to the initial noise. You remember the long-term fundamentals of exactly why you invested in the first place.
So we've covered the mindset, the systems, the exact funds to use, the math of compounding, and how to survive the bad days. Let me leave you with one final provocative thought. Take a hard look at your life right now. If you continued your current financial habits, completely unchanged, for the next 10 years, where would you end up? Would you be Vijay, trapped on that treadmill of pet, or would you be Shubham and Akash, building quiet, automated freedom? The blueprint is right in front of you. It's time to build your systems. Thanks so much for joining me on this explainer, and I'll catch you next time.